case you guys haven't noticed, many regional markets in Australia have been going absolutely crazy over the last few years. That's right, before COVID even happened, many of these regional markets were already on the rise. I remember when I first started buying properties in Launceston and Bendigo, and people thought I was crazy. It's funny how people are willing to lose hundreds or even thousands of dollars every single month on negatively geared properties and think it's crazy to buy properties in these regional hubs that pretty much pay for themselves. In today's video, we are going to take a deep dive into some of the best regional markets in Australia and look at some very important data to try to figure out exactly why these markets are doing so damn well, as well as answering this very important question: what should we expect going forward, and will these regional markets continue to perform well? Hey guys, welcome back to the channel. Today's video is going to be packed full of useful information and great content, so make sure you guys watch it till the very end so you don't miss anything. As always, what you see in front of you is not a financial advisor, and this is definitely not financial advice. I'm just some Asian guy on YouTube sharing his personal opinion. But if you find this video helpful, or if you learned something new from it, please do me a huge favor by hitting the like button right there and subscribing to the channel for more awesome content just like this. And without further ado, let's get straight into the video. Let's start by looking at the latest data from CoreLogic. We all know just how well these regional markets have performed over the last 12 months. As we can see in this graph showing the month-on-month change in dwelling values, regional New South Wales, regional Victoria, regional Queensland and regional Tasmania have all recorded very strong numbers over the last 30 days. These numbers are not as strong as the numbers seen in the capital cities, but we need to remember that the rental yield in these regional markets are much stronger than the capital cities, as well as the fact that despite the strong performance of these regional markets during the pandemic last year, these markets continue to perform very well. If we now zoom out to this graph showing the annual change in dwelling values, we can see that regional New South Wales has seen a growth of 21% compared to the 15% in Sydney. Regional Victoria has seen a growth of 16% compared to the 7.7% in Melbourne. Regional Queensland and regional Tasmania have also outperformed their capital city counterparts. Looking at just the capital growth, these markets have done extremely well over the last 12 months, and it doesn't seem like these markets are slowing down at all. I have a very good personal relationship with a lot of agents in Tasmania and in regional Victoria, and they have been telling me that the markets over there have been going absolutely crazy and the competition is insane. They're getting multiple offers within days of the properties coming onto the market, and the really good properties, the ones that have good owner-occupier appeal, large land size and are in good condition, those usually sell within days. A lot of interstate investors are also looking into these markets and making unconditional offers without even seeing these properties. It is absolutely crazy out there. Let's take a look into why these markets are performing so damn well. On this channel, we talk a lot about cash flow and affordability, and I believe these are some of the main reasons why these markets have performed so well. For some of the markets that I'm currently looking to buy into and some of the markets that I have purchased into, we're seeing rental returns of 5, 6 or even 7%. And usually these markets also have a vacancy rate that is less than 1%. This means these properties will not be vacant for very long at all. And based on my personal experience, we usually find a new tenant within days of the old tenants moving out. A vacant investment property is the landlord's worst nightmare, because it means you will now be paying the entire mortgage with your own money. If you're buying a brand new property in some of the newer estates in Melbourne and Sydney, where the vacancy rate is 4, 5 and sometimes 6%, then you are going to struggle to find a good tenant, and you should expect and prepare to lower your rental expectations as you compete with other desperate landlords who are competing for the same tenants. Just to give you a rough idea, a vacancy rate of between 0 to 2% is very good. This indicates a very strong rental market, and you are likely to get multiple applications from good quality tenants. A vacancy rate of between 2 to 3% indicates a balanced market. You are not going to have any issues finding a good tenant. However, a vacancy rate of 4% or more indicates an absolutely horrible rental market. You are going to struggle to find a good tenant, and you should be prepared for extended vacancies. Cash flow. You guys all know that I absolutely love cash flow, and my entire property portfolio is cash flow positive. and all the properties I'm currently buying are also cash flow positive as well. Let's now talk about what this means and address the common misconception that you can't get both strong rental returns and strong capital growth. My personal opinion does not mean anything, nor does anyone else's. In fact, the only thing that we should be looking at is data. Let's now rewind the clock back 20 years to the year 2000. As we can see here, Sydney and Melbourne were the most expensive markets, and these are the most negatively geared markets in Australia, where it is almost impossible to find a house that is cash flow positive. Comparing the house prices to where they are now, the top 5 performers were Sydney with a growth of around 300%, Canberra with a growth of around 350%, Melbourne with a growth of around 360%, Adelaide with a growth of around 320%, and Hobart with a growth of around 370%. As we can see in this data, the biggest, most expensive and negatively geared markets in Australia does not guarantee you better capital growth. Melbourne has performed extremely well over the last 20 years, but Hobart performed better, and Hobart also has much stronger rental returns. And Sydney, the biggest and most expensive property market in Australia, was outperformed by Canberra, Melbourne, Hobart, and even Adelaide. This is why it is so important for you to do your own research, because opinions do not mean anything until it is verified and backed up by data. And this is how I personally make my investment decisions, and it has done pretty damn well for me so far. Now back to cash flow. The reason why I personally want a portfolio that is cash flow positive is because I want my tenants to pay the mortgages for me. A property that is cash flow positive simply means that the rental income generated is enough to cover all the expenses and repayments, such as council rates, land taxes, insurance, and other outgoings. Another very important thing to understand is that a negatively geared property will lock you into your job, because that negatively geared property requires you to make additional contributions every single month because the rental income is not enough to cover the mortgage. Now, comparing that to a property portfolio that is entirely cash flow positive, it is a completely different story. Because the tenants pay for all of my mortgages, I can pretty much just buy the properties, sell it, and then forget it. And if I wanted to go to Canada for a year and enjoy my life, I wouldn't have to worry about feeding my mortgage every single month. To understand why the regional markets have performed so damn well over the last few years, we need to understand that over the last few years, these regional markets have generated a combination of both strong cash flow and strong capital growth. This combination has attracted the attention of many savvy investors who are now flooding into these regional markets. And who could blame them? Because they're getting best of both worlds, capital growth and cash flow. Just to give you guys an idea of just how different these regional markets are compared to the capital city market, I currently have a property in Melbourne that I'm in the process of developing. This is a 3-bedroom house on a large block of land about 10 kilometers from the CBD, which I paid around $750,000 for back in 2018. Now, this is the ridiculous part. Back when I was applying for the permits, I wanted to put a tenant in there just so I can get some cash flow coming in to help with my holding costs. And when I spoke to a real estate agent, they said that I could get $320 per week. I eventually decided to advertise this property and put it up for rent. And after 2 months, we didn't get a single application. Now, comparing that to a property I purchased in Bendigo around the same time, I purchased this property for $230,000. And that property now rents out for $340 per week, and we've never had any issues finding a tenant. Just think about how crazy this is. We have a property in Melbourne that costs 3 times as much, but we can't even find a tenant for it. And even if we do, our rental expectation is $20 lower than what we would get in a property in Bendigo. Look, from a cash flow perspective, this is cash flow suicide. I am literally feeding thousands of dollars into the mortgage for my own pocket every single month. The only reason why I still have this property is because it is very profitable to develop it. Since we're on the topic of cash flow, let's take a look at some of the rent growth that we have seen in our regional markets. Rent growth is very important because it puts more money into your pocket and it helps you service your mortgage when the interest rates do rise in the future. Looking at some of the top performing regional markets in Victoria, we can see that many of these markets have seen substantial rent growth over the last 12 months and 5 years. The Alpine region has seen an insane rent growth of 21% over the last 12 months and 51% over the last 5 years. This is absolutely insane considering the average rent growth across Australia is only around 3% a year. And many markets in Melbourne have actually seen a significant decrease in rent. Going down the list, we can see that Greater Bendigo, one of my personal favorites, saw a rent growth of 11.8% over the last 12 months and 26% over the last 5 years. Just to give you some perspective, that 26% rent growth over the last 5 years has increased the average rent in Bendigo from $285 to $380. That additional $95 a week adds up to be about $5,000 every single year. Not bad at all if you got a few properties in your portfolio. I know this has certainly helped me because I was previously maxed out on my borrowing capacity and I couldn't buy any more properties. But because the rental income for my investment properties have risen so much, I now have all this additional income that has allowed me to keep buying more properties and increase my borrowing capacity. We have looked at things from the investor's point of view, and we can see that why these regional markets are so attractive to investors who are looking for both capital growth and rental returns. But let's now take a look at the perspective of the first home buyers and the owner occupiers. If we look at this graph here provided by CoreLogic, we can see that in some of our most popular regional markets, the number of new rental listings have decreased dramatically over the last 12 months. We're talking about a decrease of 50% or more in some cases. This is a strong indicator that more and more people are now moving into these regional markets, and the demand from renters and owner-occupiers is increasing. Once again, referring to this article released by CoreLogic, the reason why we are experiencing such a rapid tightening of the rental market across our most popular regional hubs is a combination of less people moving out of these regional hubs and more people moving into these regional hubs. With working at home becoming more and more popular, and more businesses and big corporations allowing their workers to work from the comfort of their own home, there has been a huge shift away from high density living. There are also many railway projects underway, which will significantly reduce the travel time from these regional hubs to the capital cities in the coming years. And finally, affordability plays a massive role, because as people get pushed out of Melbourne and Sydney and they can no longer afford to buy houses in these markets, they have to now lower the expectations and move into other markets that have easy access to these bigger markets, and where houses are only a fraction of the price. We are a nation obsessed with houses. We love having a backyard for our kids and for our pets. And we're just not used to being crammed into high-rise apartments. For example, if a young family or a young couple has a budget of $400,000, their only options will be to buy a tiny shoebox apartment in Sydney or Melbourne, or they can move to one of the regional hubs and buy a nice house on a big block of land for the same price. This same concept can be applied to investors, because not every investor has $1 million to spend on a blue chip suburb in Melbourne or Sydney. So if they only have $400,000 or $500,000 to spend and their only options was between a shoebox apartment or a freestanding house on a large block of land with low vacancies, strong rental returns, and redevelopment potential, which one would you choose? However, what we need to understand is that what has happened over the last 2 years is not normal. And investing in regional markets generally comes with a bit more risk. What I'm seeing a lot right now is people literally gambling and buying into any regional market. Look, we are in a major property boom, and it is very hard to go wrong when everything is exploding in value. But when I see people buying investment properties in tiny regional markets with very small population and no population growth, that is very concerning. Another thing that is very common right now is people buying houses in new estates that have a huge oversupply of housing. This is quite common in Queensland, where developers pay salespeople a huge incentive to sell these properties to people who do not understand the market. Look, I won't go into too much detail about these markets because I don't want to get sued by these developers. But when developers start offering things like a rental guarantee or huge incentives for salespeople, then that's when you should be very concerned. Let's now answer the question, will our regional markets continue their strong performance in the years to come? when the pandemic is behind us and when things go back to normal? My personal opinion is yes and no. Yes, I think some regional markets, the good ones, will continue to perform well, but not all of them. A friend once told me that a rising tide lifts all ships, and I completely agree with that, because we are in a major property boom. Everything is growing in value, but when the tide turns, that's when we will see the real good assets continue to perform well, while the bad ones will struggle. Alright guys, this brings us to the end of the video. I hope you guys learned something new and that you guys got some value from it. If you did, please do me a huge favor by hitting the like button right there and subscribing to the channel for more awesome content. I've got some huge announcements coming up and I'm super excited to share this with you guys in the coming weeks. I've also left my Instagram and my email in the description box below if you want to get in touch with me. Stay safe out there, stay productive, and I'll see all of you guys in the next video.